Welcome to the XY Advisor Podcast, a global community of financial advisors sharing and learning with one another to drive the positive evolution of financial advice. To get involved, go to xyadvisor.com or simply download the XY Advisor app.
This podcast is proudly brought to you by Challenger. At Challenger, we want to help you ensure that your retiree clients can meet their retirement needs today and tomorrow. To access thought leadership, insights, and tips on retirement planning for your clients, head on over to challenger.com.au/XY.
Welcome back to the XY Advisor Podcast. My name is Fraser Jack, and today we are talking all things around the changing landscape of retirement. I'm lucky enough to be joined by Gayle McKew. Welcome.
Thank you for having me. It's a pleasure to be here.
You're very welcome. Now, do you want to give the listeners a quick overview of you and your business at the moment?
Sure. My focus is predominantly on helping retirees, or those just 5 years prior to retirement, right through to dealing with aged care at the other end. It's been a speciality that was actually something caused, the aged care side of it was caused by my own family's personal need. And the retirement stuff was because I started as a planner at Foster in New South Wales. And that was, Sydney's retirement capital. After people sold in Sydney, they moved to the mid-north coast of New South Wales, and that's what I cut my teeth on. So I've been doing retirement planning for too many years to count.
It's funny how Foster's known as that retirement village, isn't it?
Yeah,
around Australia.
It used to be called God's Waiting Room. Now it's Tweedheads. It's God's Waiting Room.
Oh, right. Okay, it's moved to Tweedheads. Okay, well, the people of Foster will be very happy to hear that. Now, Gayle, we are talking all things the changing landscape in retirement, and obviously there is a whole lot of different topics we can cover here. Probably one of the things I'll hone in first with you is you've done a lot of work in the space of gender and gender inequality around women in retirement. In fact, you've written books on the subject. But let's start here, I guess. There's obviously so many risks involved for women in retirement. Let's start in this space.
So when I was doing a little bit of research relatively recently, not for my book, but for another project that I'm working on, it actually is that women who are 55 plus, that demographic, are the highest at-risk people of being homeless. And that's not just in retirement, and it's not necessarily homeless the way we see thinking people living on the street. They may be living in their car. They may be couch surfing. They may be house sitting. And to be honest, there's a lot of people that are doing it, and they are hidden because effectively they have a roof over their head, whether it be a car roof or a somebody else's roof. They have a roof, and that means that those people don't necessarily have the capacity to provide themselves with a secure home abode.
Yeah, this is a horrific stat, isn't it? Like, just the thought of becoming homeless is enough to probably rock anybody. But where is this coming from, and where are we seeing it, and how do we fix it?
Well, part of it's caused by failing relationships, and also the fact that there's a massive difference in pays even now for women in comparison to men. It's anything up to 20%, depending upon the industry that you're in, that women will be paid less than a male counterpart. In fact, I remember when I was managing a practice at one point that the sales guys expected to be paid more than I was, and I had a full client load and managing 18 staff. So, and they're going, well, we should be paid more than her because we're doing sales. And I'm like, it's not about that, guys. It's about skill set.
Yeah. And so this is also the flow and effect, I guess, from the difference in balances of superannuation funds.
Oh, it is. It's a massive difference but not only that, women take time out, whether it be to have children or they get to the other end of the scale and they're pushing another set of wheels. Instead of stroller, they're pushing wheelchairs or helping people with wheelie walkers. And mainly it is, from my experience, it's the woman who stops work or reduces her work from being full-time to part-time to accommodate the care needs of the family, whether it be the younger generation, the older generation, or even grandma stopping work to look after, or reducing her work hours to look after her grandchildren so that her daughter can go and earn an income.
Yeah. Okay. So some of this homelessness could also be the concept of, as you said, but people or grandparents moving back in and being supported by other family members.
To a degree, but what I find with that is there's often an expectation, if there has been a house that mum and dad owned and mum and dad's relationship has broken up, there's not enough left after that split to actually allow either one of them to necessarily go and buy something for themselves to provide security. So then there's often then somebody goes, oh, hang on, mum can come and live with me and she can put some money into the house that we've got. So then if it's not done properly with either a life tenancy agreement or a loan agreement, then if mum falls out with the child and their partners, then the chances are they walk away with nothing.
Yeah, there's obviously a fairly risky space when it comes to combining, incomes and properties and living together and granny flats and all those types of things.
So, there's a lot of risk that is hidden, but it's hidden in plain sight and most people don't ever recognise it till they're impacted by it.
Yeah, now this is a really interesting part of it. So as you mentioned, hidden in plain sight. And I guess there would be a lot of fear and anxiety around this that may not come to the conversation immediately.
Oh, totally. There's a lot of embarrassment actually about it as well, because people sort of go, I've got this over here, as in I want to give the impression that I've got this, but they really don't. And they don't want to let you know what they don't have. And as I keep saying to people, it doesn't matter what you've got, where we are is your starting point. And if we don't know what your starting point is transparently, we literally have no capacity to help you the way you need to be helped the best way.
Is this also a conversation around reaching out for help or not reaching out for help when it comes to like maybe I don't understand what the value of advice could be if I don't have very much?
Totally. Because realistically, regardless of where you're starting, understanding the power of advice, it's not really that advice is me saying, oh, here, let me take your money, let me put it in product A. It's actually more about me going, tell me about you. Now, I'll give you an example of this. I had a lovely woman around 2 years ago. She was around 58, 59 at the time. She was a recovering breast cancer person. She'd just had a double mastectomy and she was going through all the chemo stuff. And she came in and she said to me, Gayle, I hope you can help me. And I went, why is that, my love? And she said, I've spoken to two male financial planners. They both threw their hands up in the air and said, there's nothing that I can help you with. And I went, okay, so let's talk. Is it okay if I write some rough notes and I'll ask you some questions later? And it turned out that her biggest wish was for security. She hadn't enough money to buy a house outright. We could actually then move some money around and put it into superannuation as a product, as an example, to effectively shelter it from Centrelink's testing. Now, the reason that was done was she was needing the financial support of a disability support pension and the discounts that would give her in regard to her medical treatments. So simply by listening to her, I could use something that would allow her peace of mind and capacity to have her asset and her lifestyle. Last time I went to see her, which was only about 6 weeks ago, she's in great health because this is no longer stressed to the eyeballs.
Yeah, the head plays a big part in this conversation and the emotion. Well, there's the head and the heart, isn't there? I often think of that, and you mentioned the words power of advice before, which I love that term, by the way. Thank you for saying that. The power of advice around reducing that uncertainty, reducing the risks. And then there's the financial strategies. And so a big part of this is emotional, feeling more certain and knowing where we are versus the financial side of it.
It's an incredible thing because for most people, we have a value system. I don't know whether you're aware, but and the listeners may not be, but everyone has a value system, and it depends on where security or flexibility or freedom, where they fit in your value system as to what's going to be important for you. And as an advisor, we have to adapt to an individual's value system. It may not be my value system, but I have to work with an external value system that belongs to the client so that I can help them feel whatever they need, whether it be to have a degree of certainty or to have a secure home, whatever their requirement is. That's part of my job. And I see that as the biggest part of my job rather than going, hey, here's a product.
Yep. Now
I go, here's a strategy and a solution. And then the product, which used to be when I first started planning, that used to be like, oh, we've got this many things going on. It's now also, it's almost like a byproduct of the strategy and the advice.
Yeah, certainly is. And you're absolutely right. You know, in the past, distribution came from product providers and we were all asked to, you know, we have these products called superannuation products, and aren't they amazing? They provide some great benefits, and they go out and distribute them and find people with the need. Now it's the opposite. It's the people finding the people, helping them solve their needs with strategies, and then finding products.
Totally.
Just on this concept of emotional side of it, because there's uncertainty, there's risk. But one of the things we've spoken about in the past is around the loss of identity or understanding the client's identity. How do you see that playing into this?
Oh, gosh, I have had many conversations with my clients over time where they've been long-term employees or they've been long-term professional or long-term business owners, so that instead of having them go cold turkey, for want of a better term, and say, I'm retiring on the 1st of July or I'm retiring as at the 30th of June. Firstly, I usually go, please can we not do the 30th of June? Because if there's any final payments, it's just going to get added to the rest of your taxable income, So I'm like, yeah, let's just play with it, massage the dates. But for me, mostly it's about the fact that some people identify with their occupation. They don't identify as who they are intrinsically. They go, well, let's say I'm a financial planner. I'm a mother of 3, a grandmother of 1.5. Of course, one's due in July. I'm a business owner, but I don't, that's not my identity. I'm a person who's basically willing to take risks. I'm willing to do things outside the square, but I own my values. But most people are all attached to their occupation as such. So for those people, I think it's a really important thing to, instead of just stopping work, to transition from being a full-time identity into something else. And in the past, I've actually said to people, look, you've got a whole pile of long service leave, so you're not financially impacted. How about we consider the opportunity of blending working and taking leave?
Yeah.
And they go, can you do that?
Yeah, it's
well,
amazing.
You've got to ask your HR people, but most employers are not going to want to pay out a lump sum of all of your final entitlements because that would be really bad for their cash flow. And they go, oh, never thought of it like that. And the big sweetener on that is that if they take that leave and they slowly transition from working maybe 5 days to 3 days or 5 days to 4 to 3 to 2 to 1 to none, then they can get to a point where they go, oh, I have all these other interests outside of being whatever their occupation was, and suddenly they can go, oh, I am whatever they choose to be.
Yeah, so this becomes a financial transition as well as an identity transition. Now, it's a very interesting point you raised there when it comes to, say, a professional who's always been known for this, a doctor or whatever there might be, or an accountant or a lawyer, and then they're no longer that. They're now a retired person. So as you mentioned, that conversation around values is really important. How do you have that conversation with somebody who has been known as this one thing for so long and now has to transition that?
I'm going to be honest, you can't always win on that transition, that conversation, that transition that would be ideal, because in some instances, like, for example, a lot of planners, unless they're self-employed, there's no capacity for us to be part-time employed because it costs the licensee, or it costs so much to be licensed, and that's a fixed fee. So, it doesn't matter whether you work 1 day a week or you work 5 days a week. That's the fee. So in some instances, it's not particularly viable to do that. But if it's somebody like a professional who can choose to work 3 days a week, or a teacher who can job share, for example, that's a really great way to do it. But it's all about having the conversation and going, what would you like? And letting them tell you, and then basically coming back and going, so what if we did this instead? Because it's usually, I find it's the putting of the extra thought process into it, and having managed people, I'm very aware of some of the things that your HR department can do. So it means that if you can go and ask the right questions, you can potentially get an answer that will facilitate a gradual change.
Yeah, this is a really interesting aspect of it for those clients who are employed, and going back to the HR department, sort of in a to and fro conversation around what options are.
Yeah, it's a really important factor because if you don't ask the right questions, or you don't even ask the question in the first place, usually the HR people will tell you because they like to show what they know, right? So it's a quite an important factor to just sort of go, I'm considering this. Is it a possibility? Put it as a question, and 9 times out of 10 they'll go, oh, we can make that happen.
Yeah, but you're also right with the opposite as well when you say that, if you don't say anything, they'll just give you the standard what most other people do.
Correct. And, most people who are retiring and just taking a lump sum, I'm going to give you an example. It's a person I know who had held a business for 14 years and 9 months. Now, for us, we know that there's a 15-year rule, right? And they got cranky pants on and said, that's it, I'm done. And they had a bucket load of leave that they could have used, but and this is a family member. And they just told me afterwards what they'd done, and I was like, oh my goodness, you could have done this, and this, and had a totally different outcome and paid no capital gains tax. However, now we're in a process of having to use a strategy that will help minimise the damage, but it won't take it away entirely.
Yeah, it's interesting, isn't it? A lot of the time, and that's the problem. Like there's so many complexities around our system that people don't know what they don't know, and often make decisions before seeking advice.
And they make emotional spur of the moment decisions, and that's one of the biggest issues. If you're thinking about being cranky and wanting to get out of your business, or if you're in partnership with somebody having to buy you out, go and talk to your accountant or to your financial planner. Don't just go, I'm done. Because it could be, in that instance, it was 3 months. They could have been on leave and it would have totally changed everything.
Yep. So how do we within the profession get that message out?
Oh, gosh. I don't think that there's a really simple answer on this one, because I don't know about you, but since I left school, and I was 17 when I left school and I'm 58 now, all I've ever done is money. So I've got a background of banking and commercial lending and mortgage lending and financial planning, and I've worked in accountants' offices, and I've picked up a bucket load by osmosis, simply because I've been in the industry and I've had a need to go and find something out. Whereas I know people who know about cars and they know about computers, but I don't know them, because literally I don't know what I don't know about that. So this is the problem. People don't know what they don't know.
Yeah, you're absolutely right. And the complexities around it are such where it's really hard to work out what the right questions are to ask.
Exactly. And until you are faced with something like that, sometimes it's really a case of not knowing what to ask, but to just go, I think I need to have a conversation with my accountant or my financial planner before I make these types of decisions, because literally I know people who sold their portfolios at the bottom of the GFC at a time, and I can see your eyes rolling, at a time when portfolio values had dropped by 50% plus. And the client said I was working with at the time, I did have one lady sit opposite me and she was in absolute tears. She's like, Gayle, I want to sell everything. And I was like, no, we're not going to sell a thing. I said, because it was all siloed and it was a gearing strategy. So, the house was with one place, there was a loan with another provider, then there was a margin loan and an investment portfolio. So there were 4 different silos we were dealing with effectively. And I said to her, because they're siloed, you're protected. And she was like, oh, I didn't know that. She said, I just thought it was all related to in the one big thing. And I'm like, no. So, it's actually about having us explain what people have sometimes.
Yeah, now this is a big part of the conversation, is that there is so much complexity, and understanding that from most consumers' point of view is difficult when there's so many moving parts to the jigsaw puzzle.
Well, I met with some clients yesterday and we had a conversation and they said, this is so complex. And I went, well, I understand your perspective of it. It's really complex. And last year they sold a house. We did some investing, created a strategy that means that they're not likely to ever have to pay tax for the remainder of their lives. But the point of that is they said, there's so many moving parts. And I went, and their comment was, what happens if you're not here to support us? And I went, this is for people in my occupation, this is a bog standard, I'm not saying the strategy, but it is exactly what it is. And you will be able to take this information to another planner and they'll look at it and go, oh, got it, know what that is. I said, so it's more about the skill set that we have rather than this is complex. This is to you complex because it's not taking your money to the bank and whacking it in a term deposit.
Yeah. Now, just on this understanding piece, now that complexities and understanding from the planner's point of view, but of course now it needs to be, and it probably always should have been, but really understood by the consumer and the client. And
totally.
So how do we sort of get that information across when it is complex, and how much time, I guess, do we spend on it, and how do we make that okay for the client?
Well, I usually start off by saying to clients, I'm a great planner, I'm a really rubbish artist, and then I start drawing bad stick figures and boxes and lines and people tend to get it when they can see it visually. And literally I explained, I'll use a bucket strategy pension to clients yesterday, and I showed them in a pictorial sense of drawing my boxes and saying this is defensive, this is growth, and they went, oh, okay, got it, thanks. And literally they sat on the other side of the table, both nodded, had a smile on their face and went, got it now. Before that, they literally were like, yeah, this is a bit complex. But when I explained it in a format that they could grasp, it was really simple. So this is, for me, one of the factors is that I'll draw them some really bad pictures because, as I said, I'm a rubbish artist, but it gets the story across because when you write them in front of them and you can draw them simply, then it means the concept is easier to accept.
Yeah, I couldn't agree more. There's nothing better than a few stick figures and a few diagrams to talk about stuff. Unfortunately, that's not quite what our advice documents look like, though.
No, they don't. They're like reams of paper and, yeah.
Now, just on the concept of complexity, does that add an additional layer of fear to clients?
Yeah, it does to some degree. It comes down to how well it's explained and also diversification and how that's explained. So I'm a weirdo. I often use the old analogy of a bike wheel with spokes and indicate that a spoke might be a company. And I know that I rode my bike many times when I was a kid with broken spokes because I was a bit of a wild child. And the bike still worked because the tyre had integrity. And when you explain it to people like that, they go, oh yeah, that makes sense. And then we start talking about inside the individual investment, and then the sector changes and how we work with when I'm talking sectors, I'm saying some people are more growth and volatility tolerant and others are not. So it's all about working within their comfort zone and using plain language.
Yep.
It has to be, I wouldn't say simple English, but it has to be readily understood. You have to make it so that if people aren't sure, they feel confident and comfortable enough to ask you the questions so that they can get the handle on what you're trying to explain.
Yes, I have to agree. I think every planner in the country has got analogies they use for explaining most of these concepts. Wouldn't it be great to have a bank of all those analogies and just say, there you go, there's 10 different ways of explaining that one thing?
Totally, it would.
Now, you'd be working with a lot of clients around the conversation around taking their money from a savings environment or a growth environment and then converting it to a conversation, well, now you're actually going to be spending or living on this money, and the different mindsets around how they then, translate that from being a saving to a spending, if you like.
Oh, okay. So that is a massive head spin for a lot of people, because all they've been taught to do is accumulate. But nobody ever says that when you get to retirement, that the intention behind superannuation and all of those other things that you've accumulated is that they're going to have to provide for your lifestyle when you're no longer working. And a lot of them get really uncomfortable, incredibly uncomfortable, and they go, I don't want my capital to go down. But if they go to the bank and they're going to pick up a 0.8% interest rate on $1 million, which one client suggested that he could get, I was like, woo, that's not even going to meet inflation. And then we're going to take off the impact of tax on that. And he went, oh, all right. So then we started to talk about investing to try and pace inflation and to try and protect the value of their investment against erosion. And he was like, oh, Gayle, no, I really don't like this. I'm very uncomfortable. And his wife on the other side of the coin was like, cool, I got it. I'm really happy with this. So as a planner, we often deal with conflicting and contrasting emotions. So their portfolio is currently constructed with a little bit of what works for her and a little bit of what works for him. They're both, he's slightly uncomfortable and she's like, Gayle, this could be a little bit more risky. And I'm like, yep, but this is the first 12 months, so I need you to be comfortable with this. So at our first meeting, he was like, oh, actually, that was our third meeting when I presented to him the strategy and the investments and the focus. And he's like, I don't like this. And his wife's gone, this is good, this will work. And he said, I'm going to trust her. That's the wife. If she can get it, she understands that we're going to do it. And I literally spent 3 hours having conversations around how money would come in. And it wasn't always going to be smooth because, for example, if there's a share portfolio, it pays income twice a year. It doesn't give you income every month. And he was expecting everything to pay income every month. And I'm going, no. We just have to work out a way that will get you through the first 6 months to 12 months till you get your head around this. And when we sat down for a 3-month review, he went, I've got it now. And I'm like, what have you got? Tell me. And he said, I understand this thing called growth and that it's going to compensate for, in his words, what I'm taking out. And I was like, oh, cool. Tell me more. So when it came down to it, he actually explained to me he's been watching the value of the portfolio and the changes in the actual underlying investments. And he's like, you know, I'm actually comfortable with that now. And I've gone, oh, goodness, this was a man who had been a bank manager and said, I only want term deposits.
Yeah, very interesting, isn't it? There's, that transition of getting your head around something doesn't always happen overnight. It can be a transition of, for some people get it straight away and other people just takes a bit longer and you just need to live it in a little bit and feel it and see it before.
Well, that transition to volatility, my kids, when they were young, they had managed funds held on behalf of them. And at one point, they used to measure their losses and gains in how much they paid $200 for a skateboard each, the two younger ones. And they used to measure the losses and gains on their portfolio in terms of skateboards. One said, could have bought a skateboard for what that lost. And the other one said, give it 6 months and I reckon you've made that skateboard back and got another one. And that's exactly what happened.
Yeah, it's a really good way of looking at it for people that are in that space and anyone.
And they were teenagers at the time.
Yeah, and anyone who's got kids or grandkids that want to think about that, it's a great concept, understanding what that person's economy is at the time to be able to then translate that conversation. Now, we've also talked a lot about the trade-off conversations that people have a lot when it comes to retiring and when it comes to what that might look like, a retirement might look like. How do you sort of have those conversations with your clients?
Oh, gosh, they can be really hard at times because most people have an expectation that when they retire, they're going to travel. And sorry, but COVID hit that. I have a few clients that are saying, I expected to spend 20 grand on a trip overseas last year and we've still got it because literally COVID happened and we can't leave the country. But there's also people who will go, they might spend $60,000 or $70,000 a year on lifestyle at the moment. But if they're going to spend $60,000 or $70,000 a year in retirement and suddenly their income has turned off, then we have to stop and think about, okay, let's look at what's your base requirements, what you might be willing to do less frequently, and even what you may be willing to give up. Now, there's a lot of people that are not willing to give up too much, to be absolutely honest. But in what you could maybe do is get them to think about whether they go from having a full Foxtel thing that costs whatever it is a month to, pay for view. You know, it might save them a couple of $100 a month, or they can get most of what they want by going and maybe getting a different subscription. So, you know, asking them to just even shop around and look at whether their phone bill and their internet provider is going to be able to be done somewhat cheaper through a different provider. You know, those things are people are lazy about. They're habitual. We have habits, and unless you are encouraged to look at those costs, most people never will. So that's one of my things that I sort of say to them. You've got to look at minimizing your base costs, and then we need to look at what are you willing to trade off. Yep. And the trade-off might be that instead of going overseas every 12 months, you go overseas every 2 or 3 years, but you make it within your budget.
So this probably brings up a great time of the conversation to talk about cash flow and how you work with your clients around the changes in cash flow and what they need to expect.
Again, very challenging for some people because they've been so used to having either a weekly or a fortnightly income. Some people get paid monthly, and they sort of go, what do you mean some of these investments only pay income every 6 months? And reality of it is it's a whole new mindset because they've been so used to this security of things coming to them on a regular basis. So what we tend to do is say to people, all right, talk to me about what your minimum buffer is. I'm using buffer as a term, but what's your safety net amount? And some people will go 10 grand, some people will go 20 grand, some people will go 50. It just depends on the individual because they've never done this before. So what we tend to do is say, all right, let's work on the fact that you're going to have a pool of money available to you, and you're going to, over time, draw it down a little bit before something comes in to compensate for it. How many people do you know use their cards automatically? They just tap wherever they go. So they don't really keep an eye on their bank balance. And for some people, that can be really dangerous. So what I have encouraged some people to do is go, all right, put what you're prepared to spend every week or every month into a fortnight, however you want to budget for yourself, into an account. Make that your spending account. And when that's run out, stop, because you have to have another account that basically pays for your fixed living costs. And your fixed living costs are going to be things like your electricity, your rates, your rent, those types of things. But we still have this pool of money that's there, and it's going to be topped up and depleted at different times. And the first 6 months is generally the hardest because people have fear about not having a regular income stream. And in a lot of instances, when I'm setting up retirement income streams, I make sure that there's at least a monthly payment, even though at times you could extend that. But then other people go, I need it fortnightly, because in their head they can only budget fortnightly.
Yeah, absolutely. So that's a really good point, understanding that and making sure that you get across that sort of at the beginning, I guess, of someone's retirement journey. And then and then once they've, again, become a new learned behaviour, they get to improve on that.
Well, particularly if they've been, say, in receipt of a full pension, and then all of a sudden they've received an inheritance, and I've had a few people do that, and they've actually lost their Centrelink entitlements. And for them, it's basically, it's earth-shattering, because for them, one couple had been retired for 20 years. No, not 20, 15 years. And all of a sudden they inherited quite a large sum of money. Between the two of them, it was into the 7-figure range. And lo and behold, that meant that they lost their Centrelink entitlements. And they were just devastated, because for 15 years they'd known that security of fortnightly income, and they didn't know how they were going to cope. So I had to sit down and have that conversation about, we can replace it, but instead of replacing your income on a fortnightly basis, we'll replace it on a monthly basis. Is that okay with you? I'm not sure. And then we had that conversation about having that pool of money that was their safety net. And when they could see it coming in after the first 3 months, they were like, oh, yeah, I got it now. So it's all about change and managing that and transitioning that change and their expectations into their new reality.
Yeah. Now that the concept around sudden wealth or, even accidental wealth, but probably more around this inheritance part of it, how do you see that's affecting people?
Some people literally, if it's a like a lotto win, you basically can see that will dissipate. I remember years ago, a 85-year-old lady in the town we used to live in won $2 million. And the horde of family appeared from nowhere and they all had their hands out. And then they had the expectation that they should be able to give all that and that the lady would still keep her Centrelink pension. So I had to explain the harsh reality and say, no, that won't work. But for people who've inherited, there's actually quite often guilt because they've lost the emotional connection. They've lost that parent. And that inheritance represents for them, my mum or my dad are no longer here. So there's quite an emotional thing to it. And that then throws a whole different slant on how we plan because we have the need to respect the source of the actual inheritance or the income or the capital that's come to them. And then we still have to do the education piece and go, this is how we're now going to focus your life. And then they go, oh, but I can't spend too much money because I need to leave something to my children. So you've got the money coming in with some guilt. I need to live. But hang on, I'm not going to live too well because I've got to leave money for my kids.
Yeah, the guilt's a really interesting part, isn't it? Because and it plays a factor of in the questions around, what if your parent was sitting here today, what would they say to you about this money, or would they tell you to spend it, or would they tell you to go easy? I guess that sort of gives you an indication of what they might be thinking.
Yeah, it does, but every person has a different reaction. Some people are like, oh, I have had one person go, look, mum's about to die. I'm going to get this much. What are we going to do with it? Yep. They were just very businesslike. Yep. And then others are like, they'll be in tears because literally they're grieving.
Yep.
So you've got that contrast between this is what's happened and I'm okay with it versus the other side of the coin of guilt.
Yep. Now also a lot of people have sort of have this wealth and property, if you like. They've sort of maybe bought something years ago or and all of a sudden it's worth a lot of money, and we've had, obviously a fairly steep rise in the property market over the last sort of 10, 15 years. Do you see a lot of that where people are sort of then have property but don't have cash flow, or they're trying to work out how to sell property?
Well, I helped a family recently and they had sold a house that they'd held for over 10 years and we could do some magic and turn it into something that was going to be tax-free. But the biggest part that this really hurts is people who are moving to aged care, because there are effectively 3 different contracts for entry to aged care, and there's a deemed amount effectively for what your house will be worth, regardless of whether it's a little shack by the beach a little shack by the beach is probably worth like $3 million now, versus something that might be in the country that might really only be worth $150,000. So there's that same deemed value, whether we're talking a mansion or, something far less salubrious. So those people who, say, bought in Sydney or on the coast somewhere years ago and paid next to nothing for it, they might have spent $50,000 on a house, but it might be worth close to $1 million or more. So those people, they've often got 10 grand in the bank because they're struggling to pay their rates and all their other expenses. But they've got this massive asset, and the government says, yeah, we're now going to count that against you from an aged care perspective. And it makes it very confronting for families.
Mm. And again, without time to plan, that makes it very tricky.
And 99% of the time when people move to aged care, it's because somebody's had a fall or it's an emergency. It's not something that you can plan 6, 12 months down the track. It's just like, bang, done. Now I need to move to aged care and sort this money out. Thanks.
Yeah. So in a way, you do need to have those conversations early, though.
You can never really have them at the right time, because the person who's needing care, they're 99% of the time in denial about their need for care, and they will fight tooth and nail to keep their independence.
Yeah.
So there's no right time, Fraser. It's just when you have to have that conversation.
Yeah, fair enough. Now, I wanted to talk just quickly about technology and the landscape of technology that's coming into play when it comes to people of all ages of retirement, obviously. Most of them, I would say, not coming from an upbringing of technology, let's just say, and then now having to cope with new changes and what that might bring and the uncertainty that comes with it.
Well, I've had recently 2 instances. One where we set up 2 new investments with a provider. They got an email from that provider and they basically said to each other, do you know what about this? And they looked at each other and went, oh, no. So the next thing I know, the emails ended up in their junk file, and I met with them and I said to them, did you get an email from this particular provider? And they went, yeah. Is that important? I'm like, yeah, where is it? And they went junk, and I went, pull it out. We have to actually action that. So there's a lot of fear about spam and somebody taking their identity and doing something wrong. And then there's other people who literally, and those 2 were actually IT savvy. Because they were IT savvy and they hadn't read my email yet that said you will be getting an email from this provider. They'd just gone, oh, this is rubbish, put it in the junk thing. But the other side of the coin is that I had clients recently and they are so fearful it went in the junk thing, and then they went, we don't know how to do this, Gayle. So we actually had to sit down together and I showed them how to set it up on their phone, how to log in and do those types of things. So there's a whole gap in what provider expectations are, and whether we're talking government organisations that go, hey, you need to have a MyGov account or you need to do whatever. A lot of our clients, or a lot of seniors, don't have computers. They might have a smartphone, but they still don't understand how to use a smartphone other than really how to maybe check an email, how to take a photo and make a phone call. Oh, probably, and Facebook. Just saying.
Got to check up on the grandkids.
That's it.
Yeah, or work out how to sell something on the marketplace. Fantastic. Thanks, Gayle, for chatting all about all the different things around retirement today. Really appreciate it.
You're welcome.
If someone wanted to continue this conversation, what would be the best way to get hold of you?
Well, my business is called Prosperity Planning Partners. We're based on the Gold Coast, and I have clients pretty much in every state of Australia. So it's not like you have to be Gold Coast centric. In fact, I've got some in WA, South Australia, Northern Territory. Yeah, actually every state but ACT.
Great.
And that's a territory. And you can find me at prosperityplanning.com.au, or you can just email me at gayle@prosperityplanning.com.
Wonderful. Thank you so much, Gayle. Really appreciate you coming on and sharing today.
You're welcome. I loved every minute of it. Thanks for having me.
Well, there you have it, another episode of the XY Advisor podcast. I'm Fraser and I'm joined by Emily. Hey, Em.
Hey, Fraser. How you doing?
I'm tremendous. Thank you for asking. And we're here to do some shout outs, which is a really cool part of our week.
Amazing. Yes, let's do it. So big shout out to two XY legends, Charles Blake and Timothy Reed, both smart tech extraordinaires who have joined forces to create a high-touch, high-value 8-week program to help advice firms who are serious about improving their technology and efficiency. Now, the cool thing about this program is that they are hosting it exclusively on XY, which is really exciting. And their goal is to help advice firms achieve a minimum target of 20% or more in productivity gains, which for the layperson really just means getting back hundreds of hours across your business to reinvest into those value-adding and growth-driving activities. So anything that champions efficiency and business growth and understanding and moving the needle on technology in your business is awesome. And to be able to exclusively host that on XY is extra special as well. So amazing stuff. Great to have you guys on board and looking forward to seeing the results and outcomes that come off the back of the advisors that go through this program.
Brilliant. Thank you, Em. And look, way to go, Charles. Nice work. And Tim, this is an incredible program. Two of my favorite things, efficiency and effectiveness whilst using technology. And not only that, they're using a really efficient and effective platform for running their course. So if you've got a course or a program that you want to bring to life, then reach out to Em and have a think about whether you might want to put it on the XY platform.